It's a new series. It's Audit Simplified. It's me taking technical audit topics and breaking them down, making them simple for you and giving you lots of exam tips too. I'm starting with audit risk in this episode, a big one, but I'm going to cover loads and loads of audit topics. Things like ethics, procedures, quality management, reporting. There's going to be loads and loads of episodes to come in this series. I'm going to try and do one a week if I can. And, excitingly, I've got a co-host, Hannah McDonald, who you're going to meet shortly. So that's it for this intro. Let's get cracking with the first episode. Hello and welcome to Audit Simplified. Now, in this series, I'm going to be taking complicated audit topics and breaking them down, making them easier for you to understand so that you understand the technical content behind the audit exams a little better. But as well, and probably more valuably for you, I'm going to be giving you some top tips on how to succeed in audit exams. And I'll be drawing on my experience as an audit examiner. I've taught audit for, the best part of 20 years. So I'm going to be taking loads of my best stuff and giving it to you in this podcast series. Now, I'm joined by Hannah McDonald, Hannah is a qualified accountant herself. She's already passed all of these exams. But Hannah, you're not going to be playing yourself in this series, are you? Over to you a bit.
Hi, everyone. No, I'm going to be being a student like you and asking questions that, I wish I'd known when I was sitting these exams.
Cool. So Hannah's going to kind of ask the things that hopefully you're thinking of as well that you want to know. So Hannah, what's my first question then on audit risk?
So what is an audit risk?
Okay, I want you to say for this, it's going to start a bit weird, but honestly, it will make sense. Audit risk, I want you to think of a rotten egg, right? You have opened up a packet of eggs that you've bought from the supermarket and one of them's rotten. Have you ever had that happen, Hannah?
No.
It's disgusting.
I can imagine it.
Yeah, the smell, awful. Rank, you don't even want to touch the other ones. Whatever it is you were going to cook with those eggs, you don't even want to touch it, right? Because the smell is so bad. So imagine what's happened to get that egg into that basket that is rotten, right? The chicken, maybe it's eaten something a bit dodgy. Right, it's eaten something with a bit of bacteria in it or something nasty, something horrible. Chicken's eaten it. And then produced a bad egg. Let's assume it was on a free range farm. That chicken's had a good life. It's had some outside space. But that egg has been collected by the farmer or whatever processes have gone in place to kind of check the eggs to make sure that they are okay. It's gone through that process and it's passed, even though it is rotten. And then you got to the supermarket and, Hannah, do you do this? When you buy a packet of eggs, do you have a look at them first?
Yeah, I do, just to see if any have smashed.
Yeah, because quite often one of them will have broken. So you've looked at it, you've opened it up, you had a look at it, and you didn't notice that one of them was bad. Maybe it didn't look bad. Maybe it still had a sealed shell, or maybe it had a crack in the shell or something like that. That's what made it bad. But anyway, it's gone through all those processes, right? So something went wrong in the first place with the egg. The chicken ate something dodgy. The farmer didn't spot it, or the farming process didn't spot it. And you, the person buying it, also didn't spot it. And therefore the rotten egg existed and it was in your cake or whatever it was. So I promise this will make sense now. Now, audit risk is those three things, but at a company in terms of its finances. Right, the first thing for an audit risk, what it is, a rotten egg, is that there is a wrong number, an incorrect number, or something wrong in the financial statements, and everybody missed it. And so you as a user of the accounts, you crack open your egg and it's rotten, you have a bad cake, you are making a decision based on the numbers that are in the financial statements, and you make the wrong decision because there was an error in there and it got through everything. Now, the stage that happening, how it's like the egg. First one is that there must have been something that caused the number to go wrong in the first place. An inherent risk, the chicken eating something dodgy, or the nature of the company's trade, right, exposes them to a number being incorrect in their financial statements. Then the farmer missed it. Right, that's the company's systems missing this problem, neither preventing it nor detecting it. It's called control risk. The first thing was inherent risk. The second thing is control risk. The company's systems didn't prevent it or detect it. And then thirdly, the auditor, when they came and did all of their work, they also missed it. That was you in the supermarket having a look at the packet of eggs and realizing that, well, not realizing that one of them was wrong. The auditor overlooked it. That's called detection risk. All three of those have to happen. Inherent risk, control risk, detection risk, for there to be an incorrect number in the financial statements and it kind of slipping through the net.
So all of those things are audit risks.
All three added together become an audit risk. If you're actually going to stand back and go, what's the definition of an audit risk? It's that there's a problem in the financial statements that's big enough for someone to care about. And we've signed off the audit report saying everything's okay, when actually it's not.
So how is this typically examined?
Yeah, so in the advanced auditing exam, there's always a big question on planning, which is set kind of before we're doing the audit. It's a 50-mark question. And a big chunk of that, maybe at least around 20 marks, will be a scenario where they give you lots of challenges or issues that the business is facing. And they'll ask you, can you evaluate the significant audit risks that for this particular piece of work, for this particular client? So before the audit, we as the auditor are getting ready to go out and do the audit work. And part of that is thinking about where might the problems be? Where could these issues be in the numbers? And we're doing a bit of upfront work so that we can focus in on those areas when we go out and do the actual audit.
What would the perfect student write for this type of question? An excellent student.
Okay. Now, with audit risks, they're very often, the reason there's a problem with the number is because the company is incorrectly financially reporting for something. They're using the wrong accounting. Right? They're making an error in their accounting. So what the really strong student has is really strong financial reporting knowledge, so that they can realize when the company is accounting for something incorrectly. So, for example, like if it's inventory, the rule around inventory is that it has to be valued at the lower of cost, so what it costs to produce, and net realizable value. What we can sell that inventory for. So that's the rule. And in the exam scenario, it might say this inventory cost us $1 million to produce, but it's damaged and it can only be sold off now for $200,000. And in the financial statements, it's still recorded at $1 million. Even though we could only sell it off for 200,000, it should be written down to 200,000, but management aren't doing it for some reason. So that's the kind of situation you would see in an exam question. And what the really strong student does is has a very methodical approach as to how they deal with that.
So tell me more about that methodology.
Yeah, so that approach starts by saying whether this issue is material or not. So a calculation perhaps, or assessing whether it's material by nature. If it's something a user of the accounts would care about, whether it's, even though it's the size of the number is quite small. So it starts off with assessing how material it is. It then evaluates or explains the incorrect financial reporting. Now, it won't quote the accounting standard at length. Right? So it won't say, oh, it's IS1 inventory and then write everything from the standard. Boring, really time consuming. What it will do is say inventory should be valued at the lower of cost and net realizable value. And that's about all it will say from the standard. And then it will use facts from the scenario to explain why it's been done incorrectly. So it will evaluate the accounting treatment. And then what the really strong student does is adds a bit of kind of stardust onto their answer. And the stardust is kind of going, well, why did that happen? And perhaps it's because management are getting have a bonus, and that bonus is linked to a certain level of profit. And by not writing down that inventory, management still get their bonus. So it's linking it to some sort of incentive as to why that happened, or explaining, just adding a bit of depth or a bit of context, linking it in with a wider fact in the scenario in some way. So that's the stardust bit. And then the student finishes off by being super precise about which part of the financial statements is impacted. So they don't say assets are overstated and profit is overstated. That's too vague. It's too high level, right? They'll say inventory. So, inventory is a current asset, or short-term asset. So current assets overstated by 800,000, whatever it is. And operating expenses or admin expenses are understated by 800,000 rather than profits. So it's really micro precise about which part of the financial statements are affected.
And you've already touched on this, but what are some really common mistakes that people make in audit risk questions?
Yeah, so often students see what they want to be there rather than what's actually there. And this type of student is the type of student who has learnt some previous exam answers. So their preparation has been, I'll prepare for this exam. I'm sitting the exam in 2026, for example. I'll learn the answers to the exams that were in 2022, 23, 24. And then when I get to my exam, one of the questions will probably look quite similar. And so what I'll do is I'll write the answer from 2024 or 2023. And actually within the audit exam, even if a question looks the same, the details in the scenario will be really, really different. And so the answer, although it looks like a similar question, the answer that's required is massively, massively different. So something where students really go wrong is by trying to write a pre-prepared answer rather than dealing with the issues that they are given in that particular scenario.
Very good advice. Okay, so finally, what is your number one piece of advice for anyone approaching an audit risk question?
Yeah, number one bit of advice is that you have to be flexible in what you're writing in your answer. You can't go in, although I've said have a structure to each point, right? So start with materiality, talk about the accounting treatment, add a bit of stardust if you can, and then talk about the precise accounts that are impacted. I like you to use that approach, right? But you have to be flexible as to what is going in there. Don't go in with a kind of predetermined idea of what's going to be in each of those risks. You have to respond to this stuff you're given in the scenario. And a really good bit of advice is that you don't kind of just take one fact that you're given in the scenario and really, really run with it. What you try and do instead is you look for risks where you're told 2 or 3 or even 4 different pieces of information, all of which are pointed towards there's a problem with this number. The better audit risks and the better answers are the ones where you're drawing on multiple facts and linking them together to tell a more coherent, more complete story, rather than I found one thing in the scenario and then I'm almost speculating to turn this into a big problem. Yeah, if they intend you to write a lot about an audit risk, and there'll be often 3 or 4 marks for an audit risk, generally 3 marks for an audit risk. They will give you quite a lot of information for you to run with. So don't go for things where you're not given much, because that won't be where they're intending you to go.
Brilliant advice. Thank you, Ben. See you on the next episode.
Cool. Thanks, Hannah. Thanks, everyone.